Welcome to the final chapter of the final module of the managerial accounting portion of this course. So if you haven't enjoyed managerial accounting, you can take some solace. This is the end. So this chapter is pretty unique. We really take a deeper dive and talk specifically about measuring financial performance within the company. Let's get started. The learning objectives for this entire chapter. So this is for all of chapter 19. So we're going to understand what return on investment is. We're going to examine how residual income and economic value added are also measures for evaluating short-term financial performance. And then lastly, we'll talk about this idea of transfer pricing. Okay, let's get started on ROI. So let's assume that there are two product lines for a bottler of scotch. So they sell 3-year age scotch at $20 a bottle and 17-year age scotch at $100 per bottle. And of course, the manager of the 17-year scotch brand is extremely proud of his product and says, look, our product sells for 5 times what yours does. It's clearly a more profitable product. So let's examine why that's true. So let's start up at the top with the 3-year that sells $20 per bottle. They sell 10,000 units, and therefore they generate total revenue of $200,000. The 17-year scotch sells for $100. So as a result, naturally you sell many fewer units. They only sell 3,000 units a year, but they still generate revenue greater than the 3-year scotch of $300,000. However, in order to make 3-year scotch, you need to keep about a year's worth of inventory around for 3 years. And of course, for 17-year scotch, you have to keep years worth of sales around for 17 years because the scotch needs to age. So if we were to measure revenue per unit of inventory being housed, we'd see that the 3-year scotch actually generates 6.667 per unit and the 17-year scotch only 5.882. And what that tells us is that should be an indicator that, wow, the investment we need to make in 17-year scotch is substantially greater than the investment we need to make in 3-year scotch. And we're really just looking at inventory alone. Okay, so this tells us that the amount of investment is relevant. And therefore, we get the notion of return on investment, or ROI, as being a good performance measure that might be better than something like contribution margin per unit. So the book definition says that ROI is return on sales times asset turnover, which is the same as return on sales is your profits divided by your sales. And asset turnover is sales divided by average assets. And again, this typically focuses on manufacturing businesses that carry inventory. And we often think of assets as actually being inventory, although it's not restricted to be that. So you should be aware that there are actually a number of different ways to define profit and investment for purposes of determining return on investment, making this area very customizable, meaning different businesses will define it differently. But as long as they're consistent across divisions, that's generally not a problem. You're also going to see the entire measure sometimes named return on assets, which in a way that does make sense since the denominator is in fact average assets. And finance describes return on investment a little bit differently. That would be income from the investment divided by the amount of the investment. So know that the definition of ROI is a little bit like the definition of continence. There might be a scientifically agreed upon definition, but for the most part it gets used too loosely for that to apply. Okay, so when we decompose return on investment, right, we get the two components. The first is return on sales or profit margin, right? So that is a firm's profit per sales dollar. And you can think of that as saying, look, that measures the manager's ability to control expenses and increase revenue to improve profitability. And then the other measure is asset turnover, which is the amount of dollar sales achieved per dollar of investment. And that measures the manager's ability to increase sales from a given level investment. So that's often used to measure kind of the number of turns you have in your inventory. That's why it's called turnover, right? So when I put sales divided by inventory, what you really end up with is how quickly are you turning your inventory on the average. Okay, so let's assume, aside from inventory, that all the costs are the same for 3-year Scotch and 17-year Scotch. And that it costs $10 per bottle to manufacture the Scotch. And so really the only difference is the amount of time you have to hold the Scotch in barrels before you bottle it and sell it. So again, we know that sales per bottle let's start with 3-year. So sales per bottle is $20. The number of units sold is 10. That's the revenue of 200,000. We know that the inventory in units is 30,000. So the cost of goods sold, right? So that would be the cost of each bottle that was sold is 100,000, right? That's the 10,000 units times the 10,000 cost per bottle, which means that this generates revenue minus cost of goods sold, or profits, or think of it as contribution margin, of 100,000. So that would imply the return on sales is 50%, right? So return on sales being the profit divided by sales. So asset turns represents our revenues, right, our sales, divided by the cost of our investment, or the average assets. So in this case, we're assuming, since the number of units in inventory is 30,000, the costs are $10 per bottle, then we must have inventoriable costs of 300,000. So the 200,000 divided by the 300,000 is 0.66. So if we multiply those, we get a return on investment of 33.3%, which we could also say is, of course, our profits divided by our cost of inventory. So 100,000 divided by 300,000. If we do the same measure for our 17-year Scotch, so $100 a bottle, 3,000 sold, revenues of 300,000. The number of inventory in units is 51,000, right? So that's 3,000 bottles per year times the 17 years. Cost of goods sold is only 30,000 because, again, we're assuming that's the only cost. So that would yield very high profits of 270,000, which we would expect. This is a much more premium luxury brand. So our return on sales is really off the charts, right? 270 divided by 300 is 90%. However, our asset turns are considerably slower because we have 51,000 units in inventory times $10 per bottle. We have $510,000 worth of inventory costs. So our assets are $510,000. So our revenue divided by our assets is only 0.58. That yields a still greater return on return on investment of 52.2%. So our 17-year Scotch is, in fact, a better return on investment. Okay, so return on investment, like all summary measures of performance, has weaknesses. So we certainly should be measuring our variables across divisions or business lines the same, right? And sometimes that lends itself usefully, and sometimes it doesn't. It really depends on how similar your different lines are. So in our case, our 3-year and our 17-year Scotch, we force them to be very similar, but that's not always true. And of course, only controlled assets should be included. So to the extent a division or an operating business line has assets that corporate is forcing them to use, but they don't have any control over that use, then it wouldn't really be fair to include that in their average assets. And then, of course, sometimes divisions will share assets. They might both sit within the same building, for example, and that, of course, is going to require an allocation of those costs. So asset measurement almost always creates issues because the problem is, how do you measure the assets? So one way would be net book value, right? So you just lift it directly out of your financial accounting records. That's objective, but it includes a charge off of estimated depreciation, and that tends to favor older assets because, of course, their net book value is lower. Now, in a system where the ability to generate sales or revenue is lower from an older asset, that makes sense. So think of a machine being less efficient as it ages. If, on the other hand, it doesn't really make a difference, an old machine is as efficient as a new machine, then that clearly favors older assets. Another one is gross book value. So think of that as the book value without charging off any of the depreciation. Of course, that does not reflect a decrease in the underlying value of assets, because the reality is, in just about everything but land or real estate, the value of assets generally goes down over time. And so gross book value doesn't really reflect that. Replacement cost is a measure that would capture what continuous investment is required, right? So when this item fails, what would the investment be required to make in order to keep that division or that operating or whatever it might be operating? But it's not very objective because sometimes it can be difficult to determine what replacement cost would be. Depends that, sometimes there's a conceivable market value for those items and sometimes there isn't. And then another measure is liquidation value. And think of liquidation value as being the fair market value. So what would you get for that machine if you were to liquidate it today? And that's clearly less objective. In fact, that's one of the least objective measures, again, unless there's a market for whatever those assets are. All right, so one of the advantages of return on investment is it tends to be pretty easily understood by managers, right? So think of it as, hey, this is really just my profits divided by my average assets. It's comparable to interest rates and the rate of return on alternative investments. So you measure ROI and you say, oh, look, we're returning 5% on that. Wow, that's pretty good, unless you could buy a bond for 6% with no risk at all. Right, so this gives you a way to compare this investment with other types of investments. And of course, ROI is widely used and it's reported in the business press as well. So some of the limitations are related to goal congruence. The incentive for high ROI units to invest in projects with ROI that's higher than the minimum rate of return, but is lower than the unit's current ROI. So let me give you an example. Let's say that as a business across the board, broadly, you say, we want to make 10%. But you have a particular division that's generating 12%. If we're measuring their performance on ROI, it is not in their best interest to take something that yields a 10 or 11% ROI, because that reduces the level of ROI they're operating at and in theory lowers their performance. And so you have to be a little bit careful to make sure that doesn't happen. And sometimes comparability across investment centers can be problematic. This is particularly true if you have like one service center and one manufacturing center where the level of assets is so different that trying to compare those two businesses using a simplistic measure like ROI probably does not make sense. So a few other disadvantages of ROI is, of course, because it's a summary capture figure and it doesn't include non-financial, it certainly ignores lots of the elements of performance. And this is especially true, again, in service industries where assets are less meaningful in a service industry. So things like intangibles for computer software or human capital, right? So your turnover of your people, your training costs for your people, things like this probably don't get captured in a simple ROI measure. And secondly, it tends to focus, which is dangerously true of all of the measures we talk about in Chapter 19, but it tends to focus on the short term as assets waste away, for example. So let's say you're using a machine Your ROI is increasing. So you figure, wow, look at me, I'm getting more and more profitable. Look how great I'm doing. Look how great I'm doing, until your machine breaks or needs to be replaced. Because long-term success requires constant reinvestment. And since ROI may or may not capture that level of reinvestment, that measure tends to focus on the short term rather than the long term. Okay. So again, managers may only focus on investment that exceed their current ROI and therefore skip those with a positive net present value but lower ROI. That's a disadvantage that we spoke of earlier. That brings us to the end of video 19A. 2 more videos for this chapter and then we're done. Thanks for watching.